Hello, I'm Matt Coyle and welcome to Team Coyle's YouTube channel. Today we're going to talk about my favorite subject, property taxes. If you own a home in Massachusetts, guess what? It's that time again. Your town or your city may be planning to raise your property taxes yet again. Yes, it's true. The law that was passed to limit excessive taxation seems to have failed you once again. That law is called Proposition 2.5, and it took effect in 1982. Let's take a closer look. So Proposition 2.5, for those of you who are unfamiliar with it, was designed to limit how much a town or city can collect from its residents in property taxes in a given year. Under normal rules, that levy limit can increase up to 2.5% over last year's levy, plus any additional amount for new growth, such as new construction and additions. However, that 2.5% annual limit only applies to the town's levy power. It does not apply to your individual property tax bill. And therein lies the problem, especially if you're living on a fixed income or working within a tight budget. So let's begin and try and understand how the tax bill is calculated. The good news is that the formula is very easy to understand. It's your home's assessed value divided by 1,000 multiplied by the tax rate. The bad news, there are several factors that can push your individual tax bill up by much more than that 2.5% in a single year. Let's go over the first reason. It's when your assessed values increases faster than homes in the town or the surrounding neighborhood. So what do we mean by assessed value? It's the town's estimate of your home's fair cash value. This typically represents the price a ready, willing, and able buyer or seller would agree to in order to make a deal. Now, from a homeowner's perspective, what really matters is whether the change in your assessed value increases your proportional share of the town's annual levy. Think of it like owning shares in a company. The bigger your share, the bigger is your piece of the profit or loss. With property taxes, that piece isn't profit, it's taxes owed. If your home's slice of the town's total assessed value grows faster than your neighbor's, you're going to owe a bigger share of the levy, and your tax bill goes up. Now let's look at the second reason why your taxes might increase: annual levy growth. What is a levy? Well, a levy is the total amount of property tax revenue the town collects from property owners each year. Under Proposition 2.5, the town's levy limit can generally increase by 2.5% annually, plus an additional amount for new growth. We covered this before, but new growth refers to things like new construction, additions, and subdivision. It does not include ordinary increases in your assessed value driven by changes in the real estate market. So how does levy growth affect you? Well, even if your proportional share of the town's tax base remains exactly the same, you are now responsible for the same percentage of a larger total levy. Think of it like owning the same slice of a pie that just got bigger. The size of your slice didn't change. It's still 10%. But 10% of a bigger pie is more pie. With taxes, your share of the town total didn't change either, but the total went up, so your bill goes up. Your tax bill goes up with it. The third reason is a voter-approved operating override. When normal levy growth is not enough to cover the town's ongoing expenses such as schools, public safety, salaries, employee benefits, town officials can ask voters to approve an override. Therefore, an operating override permanently increases the town's levy limit. Once approved, the increase becomes part of the base used to calculate future levy limits. The fourth reason is a capital or debt exclusion. These types of exclusion allow voters to approve additional property taxes for a particular project or expense. A capital exclusion generally pays for a specific purchase in a single year. The town raises the full cost through that year's tax bill and pays cash with no long-term borrowing. For example, the purchase of a new fire truck or a new roof on a town building. It's on your bill for one fiscal year, then it's gone. A debt exclusion, on the other hand, is different. It pays the debt service on a major project such as a school, library, or public safety building. It remains on your bill until the debt is repaid. That could be 10 years, 20, or even 30. So yes, technically it is temporary, but depending on the project, temporary could mean much of the time you own or live in your home. So what's the bottom line? If you own a home or you're thinking about buying one, consult an experienced agent like Team Coyle to better understand your cost of operating that home. Review items like the actual tax bill, the assessment history, and any pending overrides or exclusions in progress. Thanks for tuning in. I hope you found this video helpful. If you did, please smash that like button and subscribe to our channel. And let us know in the comments which topics you would like us to discuss next. Have a great day.